Welcome, curious minds, to another deep dive. Today we're cutting through some of the dense fog around a financial product that promises a lot for retirement, but honestly, often feels like it's written in a different language. I'm talking about annuities. If you've ever wondered how to genuinely secure a steady income for your later years, or if, the jargon just left you feeling confused, you're definitely in the right place. Our mission today, to really unpack understanding annuities, types, benefits, and criticisms, and give you the essential knowledge you need to feel truly empowered, not just informed.
Indeed. And we're not just going to skim the surface. We'll define them, sure, but we'll also dissect how they work, look at where they fit in the whole retirement puzzle, and really critically expose some of the hidden complexities and trade-offs. Think of this as your shortcut to understanding the what, the why, and maybe the who these tools are really for. They can be powerful, but yeah, sometimes perplexing.
Okay, let's unpack this right from the start. At its core, what exactly is an annuity? What's the basic promise it's making? Is it an investment or more like insurance? Or maybe both?
Fundamentally, yeah, it's a contract. You make it with an insurance company. And it's designed primarily to provide income, either a steady stream or maybe a lump sum at some future date. Often it's designed to last your entire lifetime. The core idea is really longevity insurance. It's a hedge against outliving your savings.
Longevity insurance, okay.
And we're mostly talking about deferred annuities here. That's where you put money in now for income later. It's different from an immediate annuity, which, well, starts paying out almost right away. So for deferred annuities, that future income promise is key, usually starting years down the line.
Got it. So setting money aside now for a guaranteed income later, that makes sense as a concept. But how much variety is there? Are there really different ways they grow the money, or is it mostly about how they pay out?
That's a great question. Because the growth engine, that's where you see the real differences between the main types. There are basically three main flavors of deferred annuities, and their names actually give you a pretty good clue about how they work, how your money might grow, and the risk involved. You've got fixed, indexed, and variable.
Okay, fixed, indexed, variable. Let's break those down then. How does each one work in terms of growing your money, and who might each type be best for?
Right. It's fascinating how they balance that growth potential versus the risk you take on. Let's start with the simplest one. Fixed annuities. These are the most straightforward, the most conservative, really. They promise a specific guaranteed interest rate on your money for a set period, maybe 3, 5, 7 years. The insurance company handles all the investment decisions, usually putting the money in high-quality bonds, things like that. They take on the investment risk, guaranteeing you that rate.
Okay, sounds super secure, predictable. But does that guaranteed rate mean you're probably missing out on potentially higher returns you might get elsewhere? Who is this really aimed at?
Absolutely, that's the trade-off, exactly. Fixed annuities are really ideal for someone who is very risk-averse, someone who prioritizes knowing their principal is safe and wants that predictable income stream above all else. People often use them to create sort of an income floor in retirement, guaranteeing that a certain amount of their basic expenses will be covered no matter what the market does.
An income floor. Makes sense.
Mm-hmm.
Okay, what's next? Indexed.
Next up, yes, indexed annuities, sometimes called fixed indexed annuities or FIAs. These offer a return that's linked or tied to the performance of a market index, like the S&P 500. And this is key, they come with built-in protections.
Protections. Sounds good on paper, but what does that actually mean? Does it limit how much I can make if the market booms? Or is it just about protecting me if the market drops?
That's exactly the right question. That's the nuance. The protection usually means you won't lose your principal due to market downturns. So if the index tanks, your account value doesn't follow it down. But the trade-off, almost always, is some kind of limit on your potential gains. It could be a cap, say the index goes up 20%, but you only get credited 7%, or maybe a participation rate, the index goes up 10%, but you only participate in 60% of that gains, you get 6%, or sometimes a spread where they subtract a percentage from the index return. So you get some market-linked growth potential, but with guardrails, in exchange for that downside protection, they sit kind of in the middle between fixed and variable.
Okay, so a bit more exposure than fixed, but definitely not wide open to the market swings. And the last one, variable.
Exactly. And then finally, variable annuities. Now, this is where you, the investor, take on much more direct market risk. And with that comes the potential for higher returns, but also the potential for losses. Your return is based directly on the performance of underlying investments, usually mutual fund-like portfolios called sub-accounts that you choose from a menu the insurer provides. Your money goes into these sub-accounts, and its value goes up or down with their performance. So the investment risk, it's squarely on your shoulders here.
Right. So variable might appeal more if you have a higher risk tolerance and want that growth potential. Fixed for the cautious folks. Index somewhere in between. It sounds like there really is a type for different comfort levels with risk.
You've hit the nail on the head. Yeah, your own situation, risk tolerance, how long until you need the money, your retirement goals, that's all crucial in picking one. But here's something really important that applies to all three types we just discussed. Tax-deferred growth. Your earnings inside the annuity compound year after year without you having to pay taxes on them until you actually start taking the money out. That can be a really significant benefit over time compared to, say, just investing in a regular taxable brokerage account.
Tax-deferred growth, yeah, that definitely sounds like a major plus. So when you buy one of these, what's the typical life cycle? Are there distinct phases we should know about?
There absolutely are. Usually two main phases. First is the accumulation phase. That's the saving part. You're putting money in, maybe a lump sum, maybe regular payments, and it's growing tax deferred. You're just building up the value. Then when you decide you want to start getting income, it shifts to the payout phase or the income phase. And many annuities are designed specifically to provide income for your entire life, maybe even for your spouse's life too. That makes them pretty powerful tools for planning for longevity, especially now that people are living longer. You usually have choices on how you receive that income, too, for a set number of years or for life.
Okay. So beyond that tax deferral, what are some of the other big benefits that draw people in, especially thinking about that certainty factor you mentioned?
Yeah, if you zoom out and look at the whole retirement planning picture, the benefits can be really compelling, particularly if certainty and guarantees are high on your list. One huge one is predictable and guaranteed income, especially with those fixed annuities we talked about. You get a promised income stream, potentially one you can't outlive. That's a massive draw for people who really seek certainty. It tackles that fear of running out of money head on. And unlike variable annuities, the investment risk is completely on the insurance company. They have a contract. They have to pay you that rate no matter what the market's doing.
So you're not lying awake worrying about market crashes affecting your retirement check. I can see the appeal there. Definitely peace of mind.
Exactly. And tied to that, fixed annuities usually have guaranteed minimum rates. So even after your initial rate guarantee period ends, let's say market rates have plummeted, there's usually still a minimum floor rate written into the contract. It offers a layer of protection against really low interest rates down the road, a safety net.
That's a good safety net feature. And what about making sure that income can support loved ones too?
Right. Many annuities generate guaranteed income payments not just for your life, but potentially for a set period, or they can continue payments to beneficiaries, like a surviving spouse. You often achieve this through adding optional features called riders, which might cost extra, but they provide that extra layer of financial security for your family.
And what about the money you initially put in? How safe is that? Is it like putting money in a bank?
That brings us to the relative safety of principal. The insurance company is responsible for safeguarding your investment and making good on its promises. But, and this is a really important distinction, annuities are not federally insured like bank accounts are by the FDIC.
Oh, okay.
So the safety really depends on the financial strength of the insurance company itself. That's why it's absolutely crucial to check their ratings from independent agencies like AM Best, Standard & Poor's before you buy. Choose insurers with high ratings. Many states also have state guarantee associations that offer some level of protection if an insurer fails, but the coverage limits vary by state.
Okay, here's where I think it gets really interesting, maybe a bit tricky. Those benefits sound good, especially the guarantees, but no financial product is perfect, right? What are the big criticisms, the potential downsides people absolutely need to know about before they even consider signing on the dotted line? What's the catch?
That is the crucial question, absolutely, because the answer is often no, an annuity isn't the right fit for everyone. And that's mainly because of some pretty significant downsides. The first big one, often a point of contention, is high fees. Annuities, particularly the variable and index types, especially those loaded up with optional riders, can carry significantly higher fees compared to other common retirement investments. Think low-cost index funds or ETFs in your 401k or IRA. We're not just talking small amounts. You can have layers of fees, mortality and expense charges, administrative fees, fees for those optional riders we mentioned, like guaranteed income or death benefits, plus, in variable annuities, the fees of the underlying subaccounts themselves.
Wow, layers of fees.
Yeah, they can really stack up. Cumulatively, it's not unheard of for these fees to eat up 2%, maybe even 3% or more of your account value each year. Compare that to a simple index fund that might charge, 0.1% or even less. That difference really compounds over time.
2 or 3% a year.
Yeah.
Yeah, that makes a huge difference over 20 or 30 years. And I've heard they can just be really hard to understand too, which is why we're doing this deep dive, I suppose.
Indeed. Their complexity is another major hurdle. These are intricate insurance contracts. They have lots of moving parts, riders, different options, specific rules. It can be tough for even savvy investors to fully wrap their heads around everything. This complexity makes it really hard to compare products apples to apples between different insurance companies, which can lead to, analysis paralysis, or worse, picking something that isn't actually the best fit for you.
Okay, high fees, complexity. What else?
Well, perhaps the biggest one, the one that really impacts your flexibility, is illiquidity and surrender charges. Annuities are designed as long-term investments, period. They typically have something called a surrender period. This is a number of years after you buy it, often 7 to 10 years, but sometimes, believe it or not, up to 15 years, where if you try to take out more than a small allowed amount, usually like 10% per year, you get hit with hefty fees. These are the surrender charges.
15 years. Wow, that is a long time to have your money locked up. So during that whole period, you basically can't touch a big chunk of that money without paying a penalty. What if life throws you a curveball?
Precisely. That's the issue. While technically you can get your money, unlike selling a house where you need a buyer, it's far, far less liquid than just selling shares in a mutual fund in your IRA or brokerage account. Most people would absolutely consider their money illiquid during that surrender period. This long lockup helps the insurance company manage their own finances and, frankly, helps them recover the often substantial commissions they pay to the agents who sell the annuities.
Okay, so commissions might be baked into why these periods are so long too.
It's certainly a factor, and it gets worse. On top of those surrender charges, if you take money out before you're age 59 and a half, you'll generally get hit with a 10% tax penalty by the IRS. That's in addition to paying ordinary income tax on any gains you withdraw. And for annuities bought with after-tax money, what they call non-qualified annuities, the IRS uses a LIFO rule, last in, first out. That means your earnings always come out first and get taxed first, so early withdrawals can be particularly tax inefficient.
Ouch. Surrender charges, plus potential tax penalties, plus ordinary income tax. So this is clearly not something you use for short-term goals or as an emergency fund or for money you even think you might need relatively soon. You have to be rock solid. Sure, you won't need that cash for a very long time.
That's exactly right. Before you even think about an annuity, you absolutely need a separate, easily accessible emergency fund, probably in something boring like a high-yield savings account. Annuities are just not suitable for regular spending needs or even big one-off things like a down payment on a vacation home. There are much better tools for that savings accounts, maybe a 529 if it's for education. The illiquidity is a defining feature, and you have to be comfortable with it.
Okay. So given all that, the potential benefits, but also the significant costs and complexity and illiquidity, where do annuities actually fit in the grand scheme of retirement planning? How do they stack up against, say, your 401k or an IRA?
Yeah, they usually fit in as a supplement, not necessarily the foundation. They can work alongside Social Security, pensions if you have one, and withdrawals from your traditional retirement accounts like 401ks and IRAs. Think of them as potentially providing one piece of the puzzle, maybe that guaranteed income floor we talked about. Structurally, remember, an annuity is an insurance contract. A 401k or IRA is more of an investment account structure offered by banks or brokerage firms. But both annuities and traditional retirement accounts offer that key benefit of tax-deferred growth. You could almost think of the annuities accumulation phase as being similar to saving in a 401k before retirement, and the payout phase being kind of like receiving benefits from a pension, a defined benefit plan.
Okay, so they have a specific role, perhaps, but are they a good idea for most people? Or really just for specific situations? Should someone prioritize putting money into an annuity before maxing out their 401k or IRA?
Generally, no. Whether an annuity makes sense really truly depends on your individual situation, your goals, your other assets, your feelings about risk and complexity. But because of those fees and the lack of liquidity we hammered on, most financial advisors would say you should probably explore other retirement savings options first. Maxing out contributions to your 401k, especially if you get an employer match, and contributing to an IRA, either Roth or traditional, is almost always recommended as the starting point. The contribution limits keep going up slightly too. For 2024, it's $23,000 for a 401k, plus a $7,500 catch-up if you're 50 or older. For 2025, that main limit bumps to $23,500, catch-up stays the same.
Right.
Those accounts often have lower fees, more investment flexibility, and definitely more liquidity. An annuity often comes into consideration only after you've fully utilized those options, or if you have a very strong need for that guaranteed lifetime income component that outweighs the downsides.
Makes sense. Prioritize the basics first. Okay, one other thing. What happens if the annuity owner passes away? Does the money just disappear, or can it go to heirs?
It depends. Deferred annuities, especially during that accumulation phase before you start taking income, usually includes some kind of death benefit. If the owner dies then, the heirs typically receive something, maybe the total amount contributed or the account's value, sometimes even the highest value it ever reached, depending on the contract. However, if the annuity has already started the payout phase, if you're already receiving income, it gets trickier. If you chose a life-only payout, meaning payments stop when you die, then yes, the insurance company might just keep any remaining funds.
Oh, wow.
Yeah. To ensure payments continue to, say, a spouse or for a certain number of years after your death, you usually need to have selected a different payout option up front, like life with period certain, or purchased an optional rider. Again, it's all in the details of that contract. It needs really careful review.
Okay, details, details, details. And just to be absolutely crystal clear on taxes, remind us again, when do you actually pay the tax on an annuity?
Right. You only pay income tax when you actually take money out. So during the accumulation phase, as it grows, no taxes are due year to year. You pay taxes when you make withdrawals or if you take a lump sum or when you start receiving those regular income payments in the payout phase. And when you do take it out, that money is taxed as ordinary income, not at the potentially lower capital gains rates. As we mentioned, for non-qualified annuities, bought with after-tax money, the earnings come out first and are taxed first, CLFO. For fixed annuities and payout, there's that exclusion ratio concept, which determines how much of each payment is considered a tax-free return of your original principal and how much is taxable earnings.
Okay, got it. Ordinary income tax rates when the money comes out. So wrapping this all up then, what's the big takeaway for you, the listener, trying to navigate your financial future? Annuities seem like these complex insurance contracts, definitely designed to help sustain people in retirement. They offer some really unique, powerful benefits, the guaranteed income, the tax-deferred growth, but they also come with some serious baggage. Those potentially high layered fees, the complexity that demands you really do your homework, and that big one, the illiquidity, locking up your money with those surrender charges and potential tax hits.
Exactly. That's a great summary. The bottom line really is this. You absolutely have to understand all the fees involved, every single one. Don't just take the salesperson's word for it. Dig into the prospectus. And it absolutely pays to shop around. Fees, surrender periods, cap rates, participation rates, rider costs, it can vary significantly from one company to the next. Don't rush this decision. Take your time, ask tons of questions, maybe even get a second opinion from a fee-only financial advisor who doesn't earn commissions from selling these. Weigh the pros and cons carefully against your specific situation, your risk tolerance, and your overall retirement plan. For many people, annuities might fit best as a tool for a very specific job, like guaranteeing a basic income floor, but probably only after they've maxed out other, generally more flexible and lower cost retirement savings options.
Right. Use the right tool for the right job, and understand the tool completely before you use it. Okay, that brings us to our final provocative thought for you today. Given this complexity, and especially that long-term commitment demanded by annuities, particularly during those potentially decade-plus surrender periods, how might really understanding these features change how you think about planning for unexpected life events? Not just planning for retirement income, but planning for a financial agility. It's something to think about. How does locking up a potentially significant chunk of your wealth in a product like this affect your ability to pivot or adapt if life throws you one of those major curveballs before retirement? Something to mull over. We really hope this deep dive has managed to shed some much-needed light on what can be a very confusing financial product.